Hello, everyone. This is Matt Fick from Financial Life Planners, and this is your stock market update for the week of March 25th, 2025. Things in the market have obviously been very volatile recently. In the past month or so, we've seen a full 10% correction, and there's a lot of concerns on what is going to happen next. I wanted to talk to you today about what our thoughts are and why we're thinking that, as well as a little bit of history on previous corrections in the past. And I'll do that by showing you a news article we recently came across highlighting that the days of set and forget investing has just ended for many Americans. That is kind of supplemented by this chart here from AA Bearish Sentiment saying that the bearish sentiment came in above 55% for the fourth straight week, which beats the previous record that was held in early March 2009. That sentiment is worse today than after this 55% pullback that you saw in 2009. And even though that is the sentiment of the general investor, that doesn't necessarily mean that things are quite like they were in 2009. And I'll show you why looking at some charts real quick. We'll start by looking at our favorite chart, the S&P 500. This is a weekly chart of the S&P 500. These two blue lines here are two trend lines, one from the base in October 2011, and then another one from a base of July 2012. And these trend lines, you can see, have often acted as resistance for the S&P 500, and the market has often bounced off of those, except for you see here that slice through in 2020, and then another drop down in 2022. Currently, we're still sitting right above those support lines. So although we have had this 10% pullback, it's not quite out of the norm yet. We're still sitting above those support lines and catching support where we would expect to catch support. Also thought it'd be interesting to show you guys max drawdown for the past 75 years. This is from 1950 to 2025. The average of those, you can see here at the bottom, is right around 14%, which isn't even quite where we've gotten to yet. So although this pullback is concerning, there hasn't been anything that is showing us to get out of the market because we're still in a normal pullback territory. If, however, we were to pull back even further and go down below these trend lines here, that is where we would see a cause for concern and want to raise cash. But we're still sitting above these lines and have often bounced back from hitting these points in the past. Looking at another chart of the S&P 500, and this is right before the end of the market close, about 30 minutes before, fighting to stay even today. But you'll notice that we're just now, especially after our bounce back that we saw yesterday, a pretty strong little rally in a one-day stint there, that we've just come back above the 200-day moving average, which is a key metric for support line that we want to see. Now, what are some things that could pull us out of this support that we're seeing from the 200-day moving average? A couple different factors at play here. The first one being if these companies that have been performing quite well over the past couple of years start to pull back on their earnings and pull back on the relative financial strength that they've had the past couple of years, that would negatively impact the market. But we're not seeing that. The last earning call has actually been very strong for a lot of companies. The other thing would be ongoing news and dragging out this tariff situation a little further. Why do tariffs and the news of tariffs negatively impact the stock market? Generally, that would be because these companies are expecting to, especially the ones that are importing these goods that are getting tariffed, are expecting to pay more to import these goods. So it may be difficult and cost more for them in the short term, which is why the market is reacting negatively to that. Now, where do we go from here? I thought it was important today to show you the difference between previous recessions that we've had over the past 10 years or so, previous downturns in the market, and what the difference is between what we're seeing right now and how important it is to catch that support at those support lines that we are right now. It doesn't mean that we are done and out of the woods quite yet, but catching support at those lines is an important show. And if we were to rally, that is showing where the beginning of the rally would come from. That's all I have for you guys today. Thank you, as always, for taking the time to listen to us. If you have any questions, feel free to reach out by phone or by email, and we'll talk to you next Tuesday. Okay, bye bye.